In the meantime, everybody who's on the call, welcome. My name is Susan Damiani. Are we recording this, by the way?
Yes, we are.
Oh, okay, great. Um, this is Susan Damiani. I'm Director of Gift Planning, and I'm also Director of St. John's University's Legacy Society, the McAllen Society. So it's wonderful to have all of you join us this afternoon. This is what we call our McAllen Power Lunch series. It was created upon the start of the pandemic, where I wanted to stay connected with everyone. And we have done so many different webinars over the years, and I involved our experts, our alumni experts that are in the field, in many different fields. This year, we're really focusing on financial and estate planning. So I've been reaching out to all of our alums that are very successful trust and estate attorneys, real estate professionals, tax accountants, like John we have today, financial planner, as well as an accountant. And I hope this will be very informative to you. You know, there's been tax law changes, and we like to keep everybody abreast of these different changes, and hopefully it helps you with your, with your planning. When you go to these professionals and you sit down with them with your plans, if I could just give a 2-minute, or not even 2-minute, quick commercial on, hopefully you're talking to them about charities and ways in which you can incorporate that in your planning. Because a lot of these types of donations, which we call plan gifts, and this is what I work on with the alumni, it really can help you. It does have a lot of advantages in helping with your portfolio and as well as with your heirs. So please, join us for many of these power lunches, because we will make you an expert in this area, and it will hopefully you'll benefit by it. And like I said, hopefully I can encourage you to think about becoming a legacy member. It is a wonderful, the McAllen Society is a wonderful, wonderful community. So with that said, I'm going to turn it over to our expert. Like I said, I'd reach out to our alumni expert. John Separano and I have been working together for a really, really long time, but I also know John for a really long time because we went to school together at St. John's University. I was in student government, and John was a cheerleader at St. John's, and I'm sure you were in other organizations as well, right, John?
Yes.
John graduated in 1985 from St. John's?
Yes.
Yeah. And you graduated with a degree in accounting and a minor in economics. And then John received his master's of taxation degree from Florida Atlantic University. But he is a certified public accountant and personal financial specialist. And he works really well with everyone. Anyone that I know that has worked with John one-on-one has really been happy and pleased with how he manages their investments. He's a wealth manager and a principal at Madeira Wealth Management, and he has over 25 years of experience in financial planning, taxation, business consulting, and financial counseling. So thank you, John, for once again presenting at one of our power lunches. Today, it's planning with purpose, building a charitable legacy by taking advantage of these 26 tax law changes. And please, I hope you have questions, because not only do we learn from John, but we also learn from each other, because we hear of practical experiences. So I hope you enjoyed today's session. Thank you so much. Turn it over to John.
Hi, everybody. Thanks for tuning in today. I don't know if we're going to make you experts today, but what we do want to do is make you well aware of some of the things that you should be talking to your financial planner with, and possibly you're also your CPA. Being a certified financial planner, having my master's in tax and a CPA, I've helped many people with modest wealth and others that have significant wealth. And what's really interesting is a lot of the people in their 50s and 60s and beyond, when you ask them about how much they have, and by many people's standard, you'd be considered wealthy, they still don't consider themselves wealthy. And that's because you spent a lifetime of accumulation. And for somebody to tell you, okay, now you can start spending 3%, 4%, or whatever dollar amount, it's very hard to turn that switch and start spending it, or in this case, giving it away. I will try to share with you many of my experiences through stories because they usually hit home with people. Sometimes people want to see their accumulation of wealth dispersed out to family members or charities during their lifetime. Others are afraid because maybe they haven't found the right financial advisor to try to help them decipher what they can afford to do with that money if they are charitably inclined, which is a topic of today. One of the things we'll talk about later in the program is a brief survey about practical applications of designing your estate planning for while you're alive and your legacy planning for when you pass on. And some of that legacy can be started while you're alive. So we can get started here. Well, so that's my background here. You've got that. I will try to not go too fast. Is trigger happy here. Okay, charitable giving is a subject when you talk to people about, it can be really simple or it can get really complicated. The complexity only comes when you want to have more and more control over things, or you have very distinguished tax needs that can only be met by setting up certain more advanced planning opportunities, such as foundations or trusts. But the starting point is you either want to know how much it costs you to give things away. There is always it's either no cost or some cost, not just the money given away, but how you give it away and what you put it into to get to a charity. The next thing is to find out and to keep more of the money that you're giving away is to know how to do it tax efficiently. How can you get the most out of giving this money away to leave you more money to either give more away or use it for yourself? So we don't want to make the IRS one of your charitable, contributions. And then the operational complexity. Some people are like, I just want to write a check. I want to make this really simple. But there may be better ways to do that, depending on whether you have IRAs, Roth IRAs, or just brokerage accounts or trusts. And then the last one is control. Sometimes people want to manage these charitable gifts over time. That's when you set up things like trusts and foundations. And we will go over all of those. So these four components here of cost, tax efficiency, operational complexity, and control can and should dictate what you do and when you do it and how much you give away. So that's a starting point. So we'll slowly get into this. What charitable giving matters today. Why? Charitable giving can be a powerful win-win. Donors can help support their causes that they believe in while unlocking financial benefits that strengthen their own long-term goals. If you were extremely successful today, whether you're single or married, the estate tax exemption before you have to pay estate taxes is $15 million per person. That is huge and a far cry from about 20 years ago when it was only $600,000. It is basically taken probably like 95% plus, the last statistic I read, of all people ever having the chance to pay estate taxes. However, things could cause you, if you're married, for example, and a spouse dies, while you're alive, your tax bracket to go through the roof, because while you're married, it's typically in a lower bracket because you have the joint benefit of filing one tax return, and the brackets actually go much higher before you reach the next threshold of going from, for argument's sake, 22% to 24%, and then jump up to 32 or 35 or 30 or higher, for that matter, depending on the state circumstances that you have. So knowing the breaking points of your own tax bracket is a great starting point to know where you are. The easiest way to look it up, you can Google this right online. If you're single, if you're married, you say 2026 tax brackets, and you could see what tax bracket your next dollar of earnings are, or if you reduce your money, how much lower you got to get to go back down into a lower bracket. So there are opportunities if you have somebody who works with you that understands taxes and design of your portfolio to keep more of the money you work so hard for, or get it more to the people that you want in a particular year or over your lifetime or when you pass. So there's opportunities with gifting to align your generosity with your financial planning. It should not be taken lightly. It should not be done in a vacuum. It should be looked at as an overall planning exercise, and understanding each method that's available to you that's custom to your unique circumstances. Let me see if I can use this. Oh, that won't work. There we go. Finally got this right. Okay, direct giving. So let's start with the easiest things first. A lot of you, especially when were younger and you wanted to make a contribution to a little cause, whatever it is, whether it's Girl Scouts, and yes, you do get cookies, or something else, okay, to your local church or whatever it is, or your school, or whatever it is later on in life, you can simply write a check. Now, this year, going forward, you do not have to itemize to get the benefit of the first $2,000 you give away. It's an adjustment to your other sources of income. So if you add up your wages, your interest, your dividends, your capital gains, your pensions, your rental properties, your Social Security, your IRA distributions, you're able to knock off up to the first $2,000 without even itemizing. If you do go and itemize, though, because you have things to itemize, which has really been reduced, quite frankly, to only 4 categories. One, I hope you don't have this category, high medical bills, okay? And it usually has to be greater than 7.5% of your adjusted gross income. So if your adjusted gross income on your front of your tax return is $100,000, to keep the math simple, you'd have to get over $7,500 in total medical bills out of pocket, including your premiums that you pay, okay, and including Medicare premiums, because they're just basically healthcare costs, that you'd have to get over $7,500 before you're able to get your first dollar to try to itemize in medical. So most people don't get medical unless you're having a real bad year, either with dental work or some other medical reason. So then there's only 3 other things. Most senior citizens probably have very little or don't have any more mortgage, so you have mortgage interest. And most people who own a home obviously have real estate taxes. And if you live in a state and your income is below a certain amount, okay, you're actually now able to exceed $10,000 in deducting taxes. So if you have state taxes this year and your real estate taxes, you may be able to itemize where previously you were not. And of course, the last piece, the 4th piece, would be charitable deductions. So that's what we'll get into. So giving away things directly with simplicity may work if you're only giving around $2,000 or less, but a lot of people who give more than that, there are better ways to look at this. So there are donor advised funds. Now, donor advised funds are only going to help you if, in my opinion, if you have a really big high income year. What does that mean? You sold the business and you want to have things to offset it. Or you sold a lot of stock or mutual funds or real estate, and you want to have something to offset it. In that year, from the proceeds you get from either the sale of something, okay, or you had stock options if you were still working and you're an executive, whatever the case may be, if your income blew up that one in any particular year, you can use a donor advised fund, which basically means you give this money into a trust called a donor advised fund, but you don't have to give it all away to the charity in that year. You can give it over time. And the reason you want to do that is because maybe you give $10,000 or $20,000 a year and you still can't itemize because you don't have enough to otherwise itemize with. But if you were going to give $10,000 a year away for over the next 5 years or so, you could do $50,000 in 1 year and save that the portion that would be over your standard deduction. So if your standard deduction was 30,000 and you gave 50, you'd really get the benefit of the extra 20. If you wanted to give more money away because you got significant other income and that is your inclination, it would save you even more. And I'll show you some illustrations later. So donor advised funds are like kind of like a mutual fund for charities, and you invest money in them, and that can grow until it gets dispersed out. As a matter of fact, once you put money in donor advised funds, if you don't give it out by the time you die, your heirs will inherit it, and then you can carry on the legacy of giving then too. So there's a lot of benefits depending on your facts and circumstances, and they're very flexible, and they're not that expensive. Typical donor advised fund has a annual fee of about 0.5% to manage it for you. Okay, so they will be an irrevocable contribution. It just that it won't necessarily go out to organizations until you tell them who to give it to, and they have to be a 501c3 public charity. Okay, but you'll get the immediate deduction for the full amount. Okay, so we'll go there. And by the way, Luke, if you're looking on, or Susan, if you see any questions as I'm going along, please interrupt me and I'll be glad to answer any questions.
Sure, no problem.
Okay, so donor advised funds, the tax deduction limits. It's only for itemizers, people who itemize. Okay, this can't be on the front page of the $2,000 because it really served no purpose to only do it for $2,000. It must exceed 0.5%. This is a new law. So if your total income is $100,000, okay, the first $500 is non-deductible. Well, that's not a big deal if you're doing a donor advised fund for $30,000, $40,000, $50,000 because it's inconsequential, but it is something to note. Donors can also deduct up to 60% of their cash contributions into this. So if you took it out of a cash account that you had, or you just got proceeds from the sale of something, you can put it in there, and up to 60% of your adjusted gross income you could put away. So if your adjusted gross income was $100,000, or let's say a big year you had $200,000, times 60% you had cash, you can put $120,000 into it. You don't have to put it all or nothing. You can put up to that amount. If, however, you had appreciated stock, you're in your taxable account or a trust, you're able to get a deduction of up to 30% of that adjusted gross income. Now, something to keep in mind. Charitable contributions get carried over if you're not able to utilize them all in the year you're in, but they're only able to be carried over up to 5 years under current law. These are things you have to be aware of and keep in touch with. But donor advised funds themselves, they go in there and you get the deduction in the first year, even though you may be giving out those deductions and ask them to send it out to churches or St. John's or whoever. Additional benefits, while it's inside this donor advised fund, you get tax-free growth. You can also be anonymous. I have a lot of my clients who don't want people calling out because they found out they gave a decent sized donation or a large donation, so it could be anonymous. It's great for succession planning, for purposes of if you want to teach your children about charitable giving. Because I have some families that they actually get together once a year and they decide in their fund where they're going to go to. So they wanted to teach their children about. So that was one of the reasons they did it after they sold their business. And then it was excellent for donating appreciation assets into the donor advised fund. Okay. Next, qualified charitable distributions. Okay. So donor advised funds, which we just talked about, are never taken out of IRAs, different than qualified charitable distributions. The definition of a qualified charitable distribution is that it's coming out of a account that is a retirement account. And that retirement account cannot be a 401k. It has to come out of an IRA. So if you're still retired and still have a 401k, and there may be reasons to have it, if you want to give any money away to charities and not be taxed on it up to a cap currently of $111,000 per person. So for a married couple, well, actually it's now $115 for each person and $230 per year. Then you must be at least 70 and a half years old. to do this, and it has to come out of an IRA and made directly to that charity. It can't go to you and then you send it to a charity. Now, you could have a checkbook for your IRA and write out checks and send them directly to the charity. But if you want to be anonymous, you want to do this, want to do that, you have to follow certain guidelines. We do this for all of our clients. We help them out annually. And more importantly, we keep track of it for them if they give away, a lot of different charities. Because when you go to get your tax returns done, if you send it to a CPA or you forget and you do it yourself and you don't put this on your tax return, you're going to get taxed on your full required minimum distribution. But if you keep track of it, you're able to reduce the amount of your required minimum distribution by the amount of these charities and have a dollar for dollar reduction on your taxable income. It's awesome, especially if you were charitably inclined in the first place. So the first place to pull money out of, typically when you have an IRA and you're over 70 and a half, or or depending on what age you're required and how old you are, you're required to either start at 70 and a half, 72, and now 73, and in the future it's going up to 75. But once you're required to take that money out, you can reduce it dollar for dollar by doing qualified charitable distributions. It's a great, simple technique to do that. There's no additional cost to do it. You just have to set it up. Let's see here. Yes,
John, we had one question from the chat.
Sure.
It's for the $2,000, can you deduct even if you do not itemize for a couple or for a single?
All right, wait a minute. For the $2,000?
Yeah, it was in the chat.
It's $1,000 per person, so it's $2,000 per couple.
Does that help?
Am I answering the right question?
I believe so.
Okay.
Emery, put in the chat if you need more clarification, but I think you answered that, John.
Okay. And they don't have to be bashful and to interrupt me and say, nope, he didn't do it. And I'll be glad to be humble and answer the right answer to the right question. So it's $1,000 per person on the charitable deductions, so to speak, by cash, and you don't have to itemize. Okay, next, benefits. I think I already said this. It reduces your taxable income and supports charitable causes while managing retirement income. Let me get this out of the way. This is kind of like right here. Okay, great. And tax exposure. All right, next one. Okay, let's talk about charitable trusts. Okay. This is where estate planning meets philanthropy. It includes charitable remainder trusts and charitable lead trusts. I'm going to show you a very simple diagram in a second that illustrates that. And the purpose of these things is for tax deductions. It's only for itemizers, okay, that would benefit from here. So you don't set up these trusts unless you're going to be putting a significant amount of money into them, typically at least $100,000 to $250,000 into them. This is not for everybody, okay? It is for itemizers, and again, it must exceed the 0.5 of AGI. So that's where you would get the tax benefit. And the income is for donors or their heirs, depending on which one. Charitable remainder trust means that the income comes back to you or somebody you designate, and then upon your demise, the principal that you put into this goes to the charity. In a charitable lead trust, the money actually goes to the charity, but they got to pay you or a designated person the income from the investments. So it depends. There's certain people that don't want any more income now, but they want to give it to their heirs or to somebody else. So that's why they do a charitable lead trust, because maybe they have too much income on their tax return. Charitable remainder trust usually is the opposite. They need the money now while they're alive, the cash flow, and then they want to give it to the charity when they pass away and they no longer need it. Okay, this is in addition to anything you would do for individuals on your own. So it supports wealth transfer if you have any kind of estate tax issues, and therefore could reduce your estate taxes. So it does require a legal setup, so there is a cost to do it. So you would not do this for a small amount of money. You would do it for at least $100,000, in my opinion, but the facts and circumstances would dictate. So this is how it looks here. Just sometimes pictures worth 1,000 words. Well, here you go. You, the donor on the left side here, this is for a charitable remainder trust. You transfer the money, okay, over to this charitable remainder trust, and you get money during your lifetime. And then when you pass, the trust goes, your principal amount, the corpus of it, goes to the charity. Pretty straightforward. On a charitable lead trust, works the opposite way. You, the donor, okay, send it over to the trust corpus, goes to the donor or other designated beneficiaries. And then so you need the income, and then upon your demise, it goes to the charity there. So it's either you need the money or you don't need the money. You either want to go into your heirs or you want to go into the charity after you leave. And you can set it up either way, and they both serve a purpose. Private foundations. I won't take too much time on this because most people do not really want this or need this, but it's typically for people who have significant wealth of like $500,000 or more. They want to put into this. This is significant wealth, and they want to control things. That is the significance of this. They want full control, and it comes with some complexity, and it comes with some cost. But there are some clients that I have that wanted to go this route because they have significant wealth and they want to control who gets it and when. And you're able to manage the investments just like if it was in your own. You can hire staff and grant broadly to different charities. You still will only get the tax deductions if it goes to 501c3 organizations. So again, this is only for itemizers only, and again, must exceed this new 0.5% of AGI. So because it considers so much money to set up and do, this is not something that is of a typical client. It's very ideal for high net worth individuals seeking control. And then you follow the guidelines that they have there based on what you can give away and who you can give it to and what it's able to hold. So it's very, very specific. So I don't want to spend too much time on it. I can always talk to you about it if you have questions. So let's go over 3 examples. Okay, I like to put things in practical terms. So there's Andy and Amy. Okay, Andy and Amy are married, both 70 and a half years old in 2026, and retired. Both are retired and have 1 adult child and 3 grandchildren. Many of you on the phone call may be similar to this. I can't see you. And they donate $35,000 a year to charity. Andy and Amy's objective is to see their gifts in action during their lifetime. What should they do? So let's get this down. They're over 70 and a half, okay? So they could do what? QCDs. They do have children, so they have family members they may want to leave some money to, but they do like the idea of giving money away, and it's fairly significant, $35,000 a year to charity. So here's their scenario, okay? Oh boy, everybody's got to follow numbers. I tried to make this really easy, okay? So if they blindly look at column 1, let's call it there, of numbers, they want to give the $35,000 away. Well, they got interest, they got dividends, they got a pension income, they got IRA distributions, they got taxable Social Security, they take itemized deductions, or do they take the standard deduction? And then they also now get, because they're under a certain amount of money, this new enhanced senior deduction. And because they make more than a certain amount of money, it gets reduced. The new enhanced senior deduction is $6,000 per person if your income is under a certain amount of money. I can't remember what the exact amount is. It's a little over 100, and I think it's like 150,000. I can always get you the details. But their taxable income winds up being 118,432. So their tax, just simply doing this, giving $35,000 a year away, they're able to itemize here. But if you do this, and the reason I highlighted this is there is a choice, but it only makes sense to either itemize when you can or not itemize. In this case, by itemizing, they're able to get an additional benefit of a little over like $4,663, the difference between $39,163 and $35,500. That additional amount is the real benefit because the government was already going to give them $35,500. So still not a bad situation. However, if they did the QCDs, okay, which means that their 35,000 comes right off of their 54,754, and now only 745, and then only 19,745 is taxed. This has a lot of impact here, okay? Because if their income was a little bit lower on overall, it could even reduce the amount of Social Security. In this case, their full amount of Social Security is taxed, but in other cases, it could reduce it. So your adjusted gross income is a major factor in a lot of things that are taxed or not taxed or deductible and not deductible. So in their case, they're able to reduce their taxable income with the same income otherwise, other than this IRA distribution here. They're able to, they would otherwise then only get $5,000 of deductible items. So they're able to take the full standard deduction plus get the full benefit of $35,000 reducing the 54,745. So their taxable income goes down to around 85,000, and their tax goes down from 14,500 to $8,000 and change. That is over like roughly like almost $6,500 savings. But just as important, the reason they're able to save that is because they drop themselves down into a lower tax bracket and save 10% there on that taxable income. This is huge when people are not aware that they can do this. And depending on what their numbers are, QCDs are always a great opportunity if you're charitably minded and you have IRAs. Okay, any questions? Luke?
We have two so far.
Go ahead.
One talking about QCD. Are your donations included in your distributions on the 1099-R, and then you reduce them on your tax return?
No, the 1099-R always tells you your gross amount of the money that came out of your IRA, which is typically your required minimum distribution or greater, because you're required to take out the minimum amount. That's called a required minimum distribution. Some people take more than that out of their IRA. And depending on their facts and circumstances, they may need to, or they're not getting good guidance if they have other types of accounts like Roths or brokerage accounts. But in terms of what shows up on a tax return, you take your 1099-R gross amount. There is a line item there for IRA, and it says gross IRA distributions. And then to the right, which it adds up with all your other source of income, is the taxable portion of it. So in column 2 here, you would only show the 19,745 here, and the gross amount over here would be the 54,745.
Great, thank you. Another one. If you are a participant in a 401k, can you just transfer the amount you want to make a QCD for to an IRA and then gift from the IRA?
Yes, that's by law. It has to get into an IRA first, then do the QCD. I do want to make mention of one other thing, and people have made mistakes. There's an ordering rule too. Let's say that you need, let's not use this example, just use mine, very simple. Let's say that you only have an IRA, you need to take $60,000 out to live, okay? And your RMD is only $30,000. You can only get a deduction up to the amount of your RMD. But you have to send out your qualified charitable distributions out, just so you know this, before you get to your RMD amount, whether it's for the full amount of that RMD or less. You have to do that first. You can't take out your money out at the beginning of the year and use it to go on a trip and you satisfy your RMD amount and then do QCDs. They won't count. It'll just reduce your IRA. So you have to do your qualified charitable distributions, as I say, even evenly throughout the whole year to use up your RMD or a portion of it, like monthly, quarterly, whatever, or do them first. Because if you don't do the QCDs before you exhaust your RMD, you may not get the full tax benefit. That's something you have to keep track of. So I usually talk to all my clients, unless we've already got it set in stone, at the beginning here and say, who are we giving money away to, assuming they're charitably inclined? Is it the same people? Is it the same amounts? Here's your new required minimum distribution. When do you want to get this out? Of course, charities like getting things early in the year. They don't want to wait until Christmas if they don't have to. And if you're going to give it away anyway, it's up to you when you do that. But we could set up anyway. But you do need to get those qualified charitable distributions out before you satisfy your RMD in total.
Great.
Okay?
And then just
Any
one
other
more.
questions right now, Luke?
Yeah. What is the New York estate tax exemption?
I've got to look that up, but I think it was $1 million. Hold on, I'll look it up for you. This is me doing things on the fly here. Hold on. Well, wrong place here. Let me get back to that. How about I look this up? Let's see here. New York State. Is this the estate tax exemption they're talking about?
Yes, estate tax exemption.
Because every state it's different. Right now, the New York State estate tax exemption is, oh, that's right. I was thinking about different state. 7 million and 0.35 per individual. And it's indexed for inflation annually. So it's basically half of the federal amount. So when you want to die, you have to move to Florida or Texas, and you don't have any state taxes for those states. You got to move there. You just got to know. They get you an ambulance to drive you straight to Florida. Okay, so let's go to the next one. All right, next scenario here. Here we go. I have a couple looks just like that. Aren't they nice, happy? Look at them. John and Janet are married, both 65 years old, so they're not in QCD territory. That's a little difference here. And they have no children or grandchildren. They are passionate about supporting charities, and they serve on the board of St. John's University. You know how I threw that plug in there for St. John's? I keep doing this, right? They give $25,000 a year, part of the McAllen Society, to charity, and upon passing, want to give $50,000 to charitable causes. John and Janet's objective is to help local charities within their budget. Okay, so what's the story here? They can't do QCDs yet. They're not old enough. But they give $25,000 a year charity, and upon passing, they want to give away 50. So a lot of this has to do with their availability of giving money away. And if they're giving $25,000 a year away, in 4 or 5 years, it's 100 grand, 100, 125,000. So here's some things that they should consider. So let me get back over here. Okay, so let's use 3 scenarios. Okay, they continue to do the $25,000 a year, right? So in their case, they have wages. One of them still working, and both of them are 60,000. Interest income 10, dividends 40, pension income 90, itemized deductions 34, or standard deduction at 35. So in this case, they would take the standard deduction because their itemized amount is less. Why? Because they missed that $35,000. Let's just assume they had no medical bills, no mortgage interest, and they really didn't have any other sources of taxes or anything, or it got phased out. They would take the standard deduction. Then they still get, because their income is below a certain threshold, $6,000 here in their case, because their income is too high. They get half of it, the limited. And then they get their charitable standard deduction on the front, because now it's an either or. When you take that $2,000 as an adjustment, you can't itemize. So they took the $2,000 that they had here, okay, over here, out of the 25, because they couldn't deduct all of this. So their taxable income winds up being 156 and change. The tax is around 22,000. If they do this every year and it's the same exact numbers, they're going to have taxes of around $89,000. Okay. If they doubled up that amount in 1 year, okay, and now every other year they're able to itemize. So in the next 4 years, they would have 2 years of itemizing, like column 2, and 2 years like column 1, which means that they're not able to itemize. So same income and everything else, but here they're able to do $50,000. So that additional 25 added to 34 gets them up so that they can itemize. So you would itemize in this case. They're now able to still take the senior enhanced discount. The taxable income drops down to 135. Their tax drops down to 17,248, and it saves them about like $4,700. Okay, so that's a lot of money. But over 4 years, they would save almost basically $9,000 here because they itemized every 2 years and gave away 50. Now this only works if they have that free cash, but if they do, that's huge. So again, this could be in a big income year for somebody or just by planning this out. Now, let's take it to a larger extent. If they did it all in 1 year for the next 4 years, whether it's the first year or the fourth year, now they get that extra $50,000 or 4 times the 25. They do it all in 1 year. They get a huge deduction. The taxable income goes all the way down to 85 from the first column of 156 in a particular year. And then they got the taxes only 6,400. So over 4 years, because you can't look at this year by year and only compare that, over 4 years, they would have saved basically a little over $14,000. So this is why kind of planning ahead and knowing people's cash flow, not everybody could do this. They may only be able to do 25. They may not be able to do these other things, so they do what they can. But if they are able to do this over 2 years, now think about this. 2 years in a tax year could be you giving it away in December of 26, and then in January of 27, which could be 5 days apart, so to speak, and you would get so much more of a benefit just by doing it in the next year or doing that twice. Every 2 years, do this. So knowing how much of an impact is compared to your standard deductions, this is why when you're talking to somebody about charitable deductions, they have to understand taxes, they have to understand the portfolio and where to pull it from, and they have to understand the design of how to design a portfolio to know where to pull it from, and whether they should be taken in appreciated assets or they should be taken in IRAs, depending on your age. There's a lot of complexity that goes into this. I take this for granted because I do this every day, but I see people make mistakes all the time. And sometimes they're not even mistakes. Let's just call them missed opportunities because they didn't know they had these options. So this is worth a lot to people in savings and in taxes by just understanding what you can do and when you can do it. Now, the thing that keeps me in business all the time is that they keep changing the tax laws. But recently, the tax laws have been pretty steady for the last 2 years and anticipated to be the same for the next 2 or 3, this year and the next 2. So this is a great time to plan because the tax rates are at their lower rates. And even with some of these subtle changes that have just come out, there's ways to plan ahead for these things, not only for giving while you're alive, but planning for when you pass. So any questions on this? No, Luke?
No questions. Nope.
Okay. All right. Last example here. This is for the younger couple, right? Now, if I had hair, I'd look like this guy, right? You know, handsome, young guy, you know, all this stuff. John and Janie are married, both 50 years old with no children. I don't know. I think he's more like 58 and she's the younger one. But they are passionate about supporting charities and they serve on the board of St. John's also. Everybody, all these cronies together, right? They give $25,000 a year to charity and they want to know if they should be contributing differently for tax purposes. John and Janie's objective is to help local charities within their budget. Okay, so now, okay, they're not going to get a senior deduction, so their tax situation is different, and they want to give a little bit less. So what should they do? So let's go to the next scenario. So again, these people are working, so they have higher income here. They get the wages, they have taxable interest, dividends, and their adjusted gross income is $240,000. Okay, they can itemize or they can take the standard deduction. In this case, they can itemize because they're probably also paying state taxes for, state income taxes and everything. So they get the benefit of the difference of 34,000 of itemized versus standard deduction of 32,200. You can't throw a big party here because you're really only getting an extra $1,800 deduction because the government was already going to give you 32,200. So in this case, they take that. But they're able to take, because they do give away money, the $2,000 over here. So in this case, it would be better for them to take the standard deduction plus the 2,000 to reduce their income, opposed to just itemizing and not getting the 2,000. Little tricky stuff here, right? So the taxable income winds up being around 206. The tax winds up being around 34. So the tax over 4 years would be around 135,000, or around the 16.4%. You go, not too bad. Well, if they again do this $50,000 every other year, and that, or gave 100,000 in 1 year, same theme here. They're able to itemize, reduce their taxable income dramatically. Yeah, let me move this out of the way. Dramatically, and then the tax savings is huge. It almost cuts it in half, and the effective tax rates drop from 16.4 to 13.2. So the total tax saved over here is going to be about the $17,000. This is simply by trying to lay out and estimating what your taxable income is going to be going forward over the next 1, 2, 3, and 4 years. Depending on the amount of money you're talking about, we can plan out even longer. But you can only go so far in tax planning because the laws may change. So for the most part, though, the itemized deductions, the standard deduction goes up with inflation, so you kind of know where that's headed. And right now, they're kind of fixated on these 4 deductions, and even the taxes may retroactively go back after this legislation period is over in, I think it's 2028. So what I'm just trying to tell you here is, so you either have QCDs, which means you're older than 70.5. You can use those QCDs. You could take advantage of things when you're retired, or you can do this while you're working. So depending on who you are and where you are in your stage of life, there may be different planning needed for each of you. And it also depends on your cash flow and when this money may be available, whether you had a windfall 1 year, whether your income is fairly consistent, whether you're going to be working right now and in 2 years you're going to be retired. So that would change and give me another scenario. Everything is very unique to the parties that you talk to. So each of you will not have the same answer, even if you have the same charitable inclination. Because your ages may be different. You may be single, you may be married. And keep in mind, I just sadly enough met with a couple very, very well off, and they found out that the wife is going to have to go through cancer treatments. It really breaks my heart when people work their whole life and get to this point, but they don't have any kids. And they go, we don't know how to give this money away and the best way to do it. And right now, we were always afraid that we weren't going to have enough. And then all of a sudden, our wealth crept up on us. And we want to see some of this money in action and know what our options are and the best way to do it. So I go through all these scenarios to help them understand what their options are. It's not my money, it's theirs. But helping them understand how they can do it most tax efficiently means you can't just understand estate planning. You have to understand their portfolio, their source of income, their outside source of income, their other than their portfolio, like pensions, rental income possibly, or their Social Security. So everybody's circumstances are uniquely different. And then page here. So charitable planning summary is this: align your goals with strategy. So first figure out what you're trying to accomplish and brainstorm. Get with somebody who understands taxes, understands portfolio design, and understands charitable planning and estate planning. Now, if you go to an estate planning attorney, they're not going to necessarily understand taxes. If you go to your CPA, they may understand taxes, but not your portfolio. And if you go to your investment person, they may know a little bit about the QCDs, but if you have a person or a firm that understands tax planning, understands investment design, understands charitable planning and income tax planning, then you can have a person that could coordinate with your other professionals so that you're not wasting time and not making mistakes. I see a lot of the mistakes made when a client who independently goes to see all these professionals independently and gets answered like in tunnel vision, and then comes out and goes, okay, that makes sense. Then you go to the next professional and the next professional, but none of them are talking. It's very, very frustrating. It's like trying to get an answer for a medical situation that you have, and they keep sending you around to specialists, and it's really hard to get those doctors to all talk together. Well, it's the same thing happens in the financial world. So that's why I really enjoy what I do, because I've had this broad spectrum of knowledge, and I hope you can find somebody just like that. So align your goals with your strategy. Options vary by complexity, control, and legacy potential. Remember the first 1 or 2 slides. Updated tax framework influences giving decision. That means you need to know what tax bracket you're in or what tax bracket you may rise to if you don't make changes. A lot of people get to where they have to start taking their money out, and they have a ticking time bomb called either a 401k plan, retirement plan, IRA, you call it whatever it is, it could be a 403b. And if you don't have things moved into the IRA like somebody asked, you can't do the QCDs. If you don't try to plan ahead when you have low tax years to smooth out your income over the next 5 or 10 years, you may wind up having these huge tax years when you're required to start taking money out of your retirement accounts and force you into a higher bracket for the rest of your life, which also means that you may probably be paying higher Medicare premiums, and also means you may be subject to what's called the net investment income tax for individuals when your passive income, which is your interest, your dividends, and your capital gains, force you to pay an extra 3.8%. There's so many things to know about. Thank God I don't have to know about plumbing. I just focus on this. So recommendations, keeping it simple. Under age 70.5, use a donor advised fund for flexible tax efficient giving. If you want to give away a large amount of money to save money in a big income year. 70.5 and older, utilize QCDs first, up to the 115 for single or 230 joint. Large contributions and income needs, consider the charitable remainder trust. What's the other one here? Large contribution and legacy goals, consider a charitable lead trust where you get the money and then the charity gets the money in the end, the principal. So, whoops, sorry about that. And then the takeaway is charitable planning should be part of a comprehensive plan, okay? Work with tax-savvy professionals who understand your unique circumstances. So let me just go right here. That's the crux of what we wanted to cover here. Do we have any more questions here?
Yes, we do. We have 2.
Yes, sure.
The first one being, if a single person goes over 200,000, what money gets taxed at 3.8%?
Okay. The net investment income tax is based on whether you're single or married. So let me just look it up. Does it just change for this year? I think.
And anybody's welcome to go off mute if they would like to ask their questions, not in the chat.
So the 3.8% applies to individuals, estates, and trusts with modified adjusted gross income. What is modified adjusted gross income? That means your adjusted gross income, and then you have to add back certain things. And the main thing that most people have to add back is if they have a municipal bond interest on their taxes, so they have to add that back. And the thresholds are $200,000 or more for single people, they have to pay it, or for married couple, it's $250,000 more. Then they're subject to the 3.8% on the amount that goes over that.
Great. And then the one was, does a donor advised fund have to give to the charity you select, or is it your preference or just a recommendation?
Well, most donor advised fund, they're going to vet any charities that you want to give them to make sure that they're financially stable and they're not going to be falling apart. So usually what you do is you before you set up the donor advised fund, and most of them are willing to work with you. And 99% of the time, you're going to get to go where you want, as long as they're a 501c3 charitable organization. You just ask them, I wanted to send it to this church, I wanted to send it to this non-for-profit organization, and they will tell you right away whether they'll follow your lead on who you want to give to. So it's very, very flexible, but they're there to help you out to make sure you're not giving to a bad cause or a bad actor, let's call them. You know what I mean?
Great. I think those are all the questions I see in the chat. If anybody wants to go off mute, they can ask another. But you're going to get this recording all sent to your email, as well as John's contact information. So if you have any questions later on, you'll have that information and to get
I
that.
do want to, Luke, we were talking about earlier, is doing a quick little survey.
Oh, yes. Let's do that.
Today, we focus specifically on different ways to give away money for charitable purposes. But estate tax planning is a lot more than that. But charitable planning is part of estate tax planning. And going to an attorney is where you can get the documents executed and maybe get some of these ideas. But if they don't have tax backgrounds or otherwise, they may not be able to help you with this. I have done other presentations where I can provide practical applications in doing your estate tax planning before you even get to the attorney. And that will help out with fees, costs, and questions. Most estate tax planning attorneys are very good at what they do, and they're technically astute because that is their job. But the practical application, knowing the clients, they usually do that only once every 3 to 5 years. And that's if the client goes back to them, because in many cases, clients get frugal, let's put it that way, and go, what do I need to go back to them for? Well, tax laws change, estate tax laws change, people in their life change, people move in and out of their life, and there may be reasons to change it. Sometimes trust makes sense, sometimes they're not necessary. It's all facts and circumstances. But where to give that money to and what charities you want to give money out of should be designed by a competent person who understands all those things, a person who has a tax background, portfolio design background, and a investment background. And I tell you this through experience. My brother and I, we kid around. I go, Johnny, why didn't mom and dad listen to you about 15, 20 years earlier? And we would have had a bigger estate when they passed. I said, way to think about mom and dad, Joe. So, but the point is that planning is something you could start any day. And getting useful, practical, implementable information is very helpful, because going into an estate planning meeting with an attorney can be very overwhelming. And it's not because the person doesn't try their best, it's because you may not have realized what you needed to bring or think about. So I try to get people prepped before they go there, knowing them, so and what they're trying to accomplish. So when they get to the estate planning, we've already sent them over a summary. If you have a financial advisor, they should be doing that with you and for you to make it a lot more easy and palatable. And in many cases, a financial advisor should attend that meeting, because they know you typically better, because they're working with you throughout the year, not through just once every 5 or 10 years in a decade. So that's my practical application. So the question is, if you're interested in doing that, please just send Luke in the questionnaire area there. Yes, I am interested, and we can come up with a presentation on the practical application, which I've given many times, and we could do that in the next few months, and we'll find the time to do that. Thank you, Luke, for the time today. And Susan, I know she had to jump off, but I enjoy working with St. John's and enjoy giving back as many chances as I get. I was there last October in person on the expert panel. I'm going to try to get up there again locally. We have offices up and down the East Coast, so many of these people moved to Florida, and I have a home here, but I also have places I stay up in New York, and it's always good to get back on campus. So I hope that you enjoyed today's presentation, you find it practical and applicable.